Good afternoon and welcome to our second speaker series event of 2022. My name is James O'Brien, Managing Partner. Due to the recent developments in Ukraine and continued market volatility, we thought it'd be beneficial to host a speaker with global market expertise to provide context on how the Ukraine conflict could impact the global economy. We're pleased to be able to pull this together in short order and appreciate David's ability to speak with us. And we want to thank all of you for joining us today. We believe the more information and perspective we can provide during these times, the better. We're fortunate to have David Lebovitz from JP Morgan here with us today. David will share his perspective as to how the situation in Ukraine, continued inflation, and forthcoming interest rate hikes may impact the global economy. After David's presentation, Chad Wanger will facilitate the Q&A portion of our event, and Terry Propp will finish with a few closing comments. You can submit your questions using the Q&A button located at the bottom of your screen. A replay of this event will be made available within 24 hours for clients of Gale Capital Partners. Now I want to introduce our speaker. David is Executive Director and Global Market Strategist on the JP Morgan Asset Management Global Market Insights Strategy team. In this role, David is responsible for delivering timely market and economic insights to clients across the country. David helped build the Market Insights program in the United Kingdom and Europe, has appeared on Bloomberg TV and CNBC, and is often quoted in the financial press. David first joined JP Morgan in 2010. David obtained a BA in Political Science and Philosophy with a concentration in Leadership Studies from Williams College, and earned a dual MBA degree from Columbia University and London Business School. So without further ado, I'll turn it over to you, David.
All right, great, thank you, and good afternoon, everybody. I hope you're all doing well. So while we get the slides pulled up here on the screen, in terms of the roadmap for today, I want to start by talking a little bit about the volatility that we've seen over the course of the past couple of weeks and kind of talk through how we're thinking about the risks stemming from the situation in Eastern Europe. I then want to talk a little bit about how our views have and have not changed around the direction of travel for the global economy, how we believe this will impact inflation, and importantly, what it all means for our friends at the Federal Reserve. At that point, I will shift gears and talk a little bit about the risks and opportunities that we're seeing across the capital markets before diving into Q&A during the remainder of our time together this afternoon. And so if we dive right in here on page 2 of the presentation, you know, I have a daughter who is almost 3 years old, and she has two types of cries. One is signal and the other is noise. You know, one of her cries is, "Hey, Dad, stop ignoring me. I want your attention." The other cry is, "Dad, I just hit my head on the coffee table and you better come quick." The former is noise. The latter is a signal. And in terms of what we're seeing in equity markets today, I do believe that as terrible as the situation in Eastern Europe is from a social and a humanitarian perspective, this is still very much noise. And the chart on the right-hand side does a nice job of illustrating why. What we're showing here in gray is earnings expectations for the S&P 500 companies over the next 12 months. The blue line represents the forward PE ratio, or the multiple of the S&P 500, which is simply a measure of valuation. And the green line represents price returns year to date, which is basically the net of the gray and the blue line. And you can see that the decline in equity markets that we've seen, not just over the past couple of weeks, but really over the course of the year as a whole, has been purely a function of a decline in valuations. Actually, earnings expectations have continued to rise. And to me, if the profits are going to be there and what's happening is not materially impacting the outlook for corporate earnings, then what we're seeing from a volatility perspective is very much noise. You know, I said this to a client this morning, the situation in Eastern Europe is noise. The Fed, on the other hand, has sent a signal. And the Fed has sent a signal that they're going to begin hiking rates most likely next week when they get together for their March meeting. We'll talk more about that in just a couple of minutes, but I think it's important to frame what we've seen particularly, as of late, as really being driven by a deterioration in sentiment as opposed to a deterioration in the underlying fundamentals. But nonetheless, the situation in Eastern Europe is very difficult to ignore. And if we flip to the next chart, whenever we think about geopolitical conflict, we always try to think about it in the context of, is there a direct transmission mechanism whereby what is happening can impact the economy? And in the case of the current environment, that transmission mechanism, that channel is energy prices. And look, this matters a lot more for Europe than it does for the United States. We came into this whole episode with energy prices in Europe already quite elevated, and this is very much exacerbated an already very challenging situation. But in the United States, I actually think we're going to be able to deal with this disruption in energy supply. And you can see that in the chart in the bottom left-hand corner, specifically that blue line, which shows the number of active rigs here in the United States. That number continues to trend higher. And I do believe, particularly given some announcements today out of Washington, that you will see further increases in the number of shale rigs that are operating and pumping oil, which again should help us to address the shortfall that we're experiencing in the current environment. And so from an equity market perspective, again, this is still just noise. We're watching energy prices to gauge whether or not it evolves into a signal. And against that backdrop, if we flip to the next chart, what I would say is that our views on global growth are frankly somewhat unchanged from where we started the year. We're a little bit more downbeat on growth in the developed world, particularly Europe, a little bit more upbeat on the growth narrative in emerging markets. And what we're showing here on this chart is an economic indicator called the Purchasing Managers Index, or PMI. These are timely monthly economic indicators. They tend to track the pace of economic growth fairly closely. And importantly, 50 is the key level that separates expansion from contraction. So if you look at those numbers on the right-hand side, anytime you see a number above 50, it means an economy is growing. Anytime you see a number below 50, it means an economy is contracting. But for the purposes of this chart, we are showing things as a heat map where green means good and red means not so good. You can see that for the most part, through the end of February, the global economy was hanging in there. We had seen some softening in the emerging markets. Developed markets were holding up pretty well. But again, we actually think that Europe is going to come under a bit of pressure here, and emerging markets are going to see growth begin to improve. The reason why has to do with energy spending. And again, we're seeing energy spending in places like Europe and to a certain extent in the United States increasing as a share of total consumption. And what that means is that basically consumers can spend less on other stuff because they're forced to spend more filling up their car at the pump. Now, again, or heating their home. Now, again, this is a much bigger deal for Europe than it is for the United States. We do think that the risk of a recession later this year in Europe is rising, but recession risk here in the United States for 2022 still seems relatively contained. And importantly, when it comes to the emerging markets, and specifically those emerging markets in Southeast Asia, Southeast Asia and Latin America, we do believe that higher commodity prices could very much be a tailwind for the underlying pace of economic growth. So net, again, our global forecast is effectively unchanged. A little bit more of a contribution from EM, a little bit less of a contribution from developed markets. But if we flip to the next chart, the elephant in the room remains the topic of inflation. Now, you can see on the far right-hand side of our inflation heat map that, coming into this whole episode, inflation was very much running hot around the world. There were a couple of places in the emerging markets that had begun to tighten monetary policy last year, and that had begun to bring inflation off the boil. But you look at the United States, you look at Europe, inflation running at the high end of the range that's been observed over the course of the past 10 years. We get a lot of questions around the direction of travel for inflation and what the developments in Eastern Europe may mean for the inflation narrative. The way that I think about it is mathematically, higher energy prices are going to keep headline inflation elevated over the next couple of months. And so people were originally thinking that inflation was going to begin to cool off here. I'm not so sure that's going to be the case. Again, purely a function of the fact that energy prices are higher today than they were a year ago, that's going to support headline inflation. But what the Fed looks at and what a lot of investors look at is the core measure of inflation, and that excludes food and energy. We do believe that may actually cool off a bit faster than we were originally expecting, because some of that very robust demand for goods and services is going to dissipate, right? Again, consumers are going to be forced to spend more filling up their cars, heating their homes, and that's going to give them less income that's available to be spent on goods and services. And so, generally speaking, we think inflation is going to come off the boil this year. We do believe that we're in a period where inflation is going to remain well above the Fed's 2% target for the foreseeable future, but we do not believe that inflation is in the process of evolving into a structural issue. By our lights, there are four major forces that have weighed on inflation for the past 40 years, and absent a shift in one of those forces, we see it as very difficult for inflation to get out of hand, particularly over the course of the longer term. And these are forces like income inequality, demographics, globalization, technological adoption. Again, these are things that have weighed on inflation for the better part of the past 4 decades. And absent a shift in one of those forces, we do believe that they will weigh on inflation over the course of the years to come. But that leaves us in kind of an interesting spot. Inflation's high today. We don't think it's going to stay that way over the longer term, but how long is it going to remain elevated? And what should we be watching to gauge how sticky inflation will be when all is said and done? Well, the first thing that we're watching is housing. Home prices are up substantially in the United States over the past 12 months. And importantly, that has only just begun to show up in the official inflation statistics. And so by our lights, housing is basically going to put a floor underneath inflation throughout the better part of 2022. The second thing, if we flip to the next chart, has to do with supply chain disruptions and corporate behavior. So you can see in that chart on the left-hand side that supply chains remain disrupted and delivery times remain quite elevated, despite cooling off a bit relative to December of last year. But it's not as much about delivery times or supply chain disruptions. It's about how businesses respond to those dynamics. And you can see in the chart over on the right-hand side, that purple line represents input prices. That gray line represents output or selling prices. One of the things we've seen companies do in response to higher input prices is actually increase their selling prices. Now, this is something that did not occur in the aftermath of the financial crisis. Companies were way too nervous that they were going to end up undermining demand if they passed along any increases in price to the end consumer. That is not the case in the current environment. Another thing that will contribute to the stickiness of inflation here is this pricing power, this willingness to pass along higher costs to the consumer when all is said and done. And then the third thing we're watching to gauge the medium-term trajectory of inflation is illustrated on the next slide. Frankly, it is the dynamic in the labor market. Now you can see the gray line represents the unemployment rate. The blue line represents wage growth. As the unemployment rate has fallen from a level of 14.7% in April of 2020 to a level below 4%, 3.8% in February of this year, wage growth has accelerated to the fastest pace that we've seen since the late 1970s and the early 1980s. Now, we get a lot of questions around what's driving this wage and this labor market dynamic. This is a function of supply. This has very little to do with demand. There are just not enough workers to fill the jobs that employers are trying to fill. And we think that there are a couple of reasons why labor supply is limited. The first has to do with the financial position of the consumer. So the consumer was really bailed out quite nicely during the pandemic. And as a result of enhanced unemployment benefits and stimulus checks, consumer cash balances are now elevated relative to where they stood prior to the pandemic. And we do think that that's keeping people on the sidelines to a certain extent, but eventually those cash cushions get worn down. People need to re-engage in the labor market, and we very much expect that that will be the case as we move into the second half of this year. The second thing that's going on has to do with the skills mismatch. Now, the economy is opening back up, but if you looked at the labor market prior to the pandemic, you had about 80% of the jobs in services and about 20% of the jobs in manufacturing. Now, services have been on ice and manufacturing has been firing on all cylinders, but the reality is you can't necessarily take a bartender and put them on an assembly line making consumer goods. You can see it in the survey data. Business employers, they post these jobs, they get plenty of applicants, but then the applicants show up and they're wildly unqualified to do the job that they've applied to do. Again, as the services part of the economy continues to open back up here, we do believe that this will be addressed, but is certainly something that's limiting labor supply very much in the short to medium term. And then the third thing that's limiting labor supply is near and dear to my heart. That's the issue of childcare. I kicked off 2022 with a call from my daughter's preschool that they were going to be closed for a couple of weeks because all the teachers had COVID and all the substitute teachers had COVID as well. Now, we're very fortunate in the sense that my parents don't live all that far away. I called them up. I said, hey, grandma, grandpa, you want to come hang out with your daughter so my wife and I can work? They said, sure, that sounds great. Not everybody is in that position. And we do believe that as the pandemic fades, we will see that issue begin to fade as well. But the reality is that the labor force participation rate for females fell by about twice as much as it did for males when the pandemic first began, and has really failed to show any signs of rebounding over the course of the past 24 months. And so we think inflation is going to be sticky. We do believe that inflation will not evolve into a structural problem. But if we flip to the next slide, the math around what the Federal Reserve is going to do has become infinitely complicated in the current environment. And, it was just a couple of weeks ago that the Fed people were looking for the Fed to hike 6 or 7 times in 2022. That has very much come off the boil. But we do expect the Fed is going to begin hiking rates when they get together for their March meeting in the middle of next week. Chairman Powell was very clear in his testimony before Congress last week that the Fed intends on starting to hike rates here in the month of March. And by our lights, the Fed will hike next week. They'll hike again in May, and they'll hike for a third time in June before coming up for air, taking a look around and determining what makes the most sense for the back half of 2022. It's very interesting that if you listen to the press conference after the January meeting, Fed Chairman Powell used the word decision 15 times during that press conference. 14 of those 15 mentions were in the context of no decision has been made. The reality is that the Fed is kind of behind the curve. They need to start hiking rates. They're going to start hiking rates, but they're not necessarily going to hike as aggressively as a lot of people originally thought. And I think when we consider that inflation narrative where core inflation cools off a bit faster than people originally thought, the Fed is effectively going to find itself with more wiggle room than it originally anticipated. And that wiggle room, I believe, increases the chance that they're able to thread the needle, get inflation under control without killing the economic recovery in the process. And so in general, we recognize what's going on in Eastern Europe. We recognize the risk that stems from higher energy prices, but we're inclined to stay the course in terms of asset allocation. We're still finding things to do across the capital markets. We are, however, becoming a bit more targeted when we think about building diversified portfolios. And against the backdrop of uncertainty and instability, and importantly, rising rates, fixed income has become increasingly challenging as an asset class in general. If we flip to the next chart, I would go as far as to say that from 20,000 feet, the bond market is broken. What we're showing here on this slide, the position of the diamonds relative to the x-axis represents the correlation of each of these sectors to the S&P 500. And then the position of the diamonds relative to the y-axis represents their average yield over the past 12 months. Now, again, you can see that the bond market is kind of broken here. You look at those blue diamonds in the bottom left-hand corner, things like US Treasuries. Yes, in theory, they zig when the equity market zags, but they're not really paying you anything when all is said and done. And you juxtapose that with what we show over on the right-hand side of the chart, assets like high yield and emerging market debt. These parts of the bond market are providing you with more robust streams of income, but they're not providing you with any meaningful protection if and when the equity market gets a bit choppy. And so we continue to advocate for a barbell approach when it comes to investing in fixed income. We recognize that clients need more defensive core fixed income in portfolios, but we think there are better ways of building that exposure beyond just owning US Treasuries. We like the idea of adding in investment grade corporate bonds, different types of securitized paper, municipal bonds look quite interesting as well. And then when it comes to generating income, we are comfortable moving to the right-hand side of the chart, owning things like high yield and owning things like emerging market debt, but we do not want to bottom fish. This is not about finding the lowest rated, highest yielding security to try to beef up the income that our portfolios are generating. This is about responsibly reaching for yield, particularly given that the Fed is about to begin normalizing monetary policy. It's important to remember there were a number of cracks that were beginning to form in the fixed income markets prior to the pandemic in early 2020. And I do believe that some of those cracks will begin to reemerge as the Fed normalizes policy here going forward. So again, fixed income, a bit of a balancing act, but finding things to do to generate both yield and play defense against volatile equity markets. But importantly, if we flip to the next chart, the search for income doesn't just exist within fixed income. If you look at that chart at the bottom, you can see that although emerging market debt and high yield are two of the highest yielding asset classes in the current environment, what comes right after them? Preferred stocks, global real estate, even plain old developed market equities are yielding more than the 10-year US Treasury. Again, we think that the search for income needs to go beyond traditional fixed income and incorporate parts of the equity market, various types of alternatives. Again, the bond market is somewhat broken. That requires a more diversified approach when it comes to income generation. Now, speaking of equities, if we flip to the next chart, we were talking earlier about higher interest rates. And it's important to recognize that the primary channel through which interest rates pressure equities is valuations. Right? All things equal, an increase in interest rates should push down on the forward PE ratio of the S&P 500. That's very much what we saw at the beginning of this year. That forward PE ratio has declined further on the back of geopolitical instability and an increase in uncertainty. But the bottom line is that in this type of environment, earnings are king. Cash flow is king. And so we want to own those sectors and those industries which stand to generate the most robust streams of earnings, given the macroeconomic backdrop that we believe is going to develop here over the course of the next 12 to 18 months. And you can see over on the far right-hand side of this chart that 2021 was a spectacular year for corporate profits. The S&P 500 saw earnings per share increase by about 70% for the calendar year as a whole. But importantly, you look at the breakdown of where that earnings growth came from, and about 2/3 of it came from expansion in profit margins. Now, we've been talking about higher transportation costs, higher input costs, higher wages. These are all things that are going to weigh on margins over the course of 2022. And so we're particularly focused on those parts of the market that will be able to pass along those higher costs to the end consumer. Those are things like the industrial sector, the financial sector, the materials sector. We're lukewarm on the energy sector. I think a lot of the easy money there has very much been made, but then we want to barbell that exposure to the more cyclical and the more value-oriented parts of the equity market with allocations to things like technology and healthcare, which, if economic growth slows more than we currently expect, should outperform those more cyclical and those more value-oriented sectors. Again, very much about a barbell approach when it comes to navigating US equities. If we flip to the next chart, we've been getting quite a few questions from clients around what they can do to protect their portfolios against these higher rates of inflation. Now, you can see very clearly on this slide that commodities, if we're looking down in the bottom right-hand corner, have historically done a good job hedging against the risk of higher inflation. Statistically, over the past 20 years, every 1% move in headline inflation has been matched by a 10% move in a diversified basket of commodities. By our lights, this isn't about owning oil and gold or owning silver and livestock. We want to spread the chips around as much as possible, and we do believe that a diversified approach to commodities could help investors protect their portfolios against the risk of higher inflation. Now, I'm not sure that we're embarking on a commodity supercycle like we saw in the early 2000s, mostly because I'm not sure that China can go through the type of industrialization that we saw during that period of time all over again. But after nearly a decade where commodities have been in the gutter, we do think that they could act a bit better going forward, particularly if these issues in Eastern Europe extend for longer than we currently believe that they will. Now, if we flip to the next chart, we get a lot of questions also about what happens with the US dollar. And to an extent, there's a tie-in here with what we were just talking about on the commodity front. A lot of people have been saying to us, well, David, so you're telling me that the Fed is going to start hiking rates. You're telling me that the US economy is going to look better than Europe. Shouldn't that all lead to dollar strength? And I think given the uncertainty in the current environment, it's not surprising to see the dollar catching a bid. I mean, it's very much a risk-off tone in markets, and people are fleeing to quality. But if you actually look historically and you assume that these geopolitical issues run their course sooner rather than later, historically, the dollar has actually strengthened into the first Fed rate hike and then weakened in the aftermath of that initial increase. And we think that, again, assuming that this conflict doesn't extend over the course of the next couple of months, we could very much see the same thing, where despite some near-term strength, the dollar actually weakens over the better part of 2022. And where we have even more conviction is around our view on the dollar in the long run. If you look at that chart in the top right-hand corner, you can see that the United States runs a chronic current account deficit. So put differently, we are a net borrower of dollars from the rest of the world. What this means is that over extended periods of time, the dollar should gradually weaken, basically taking what has been a headwind to commodities and international equities and allowing it to evolve into more of a tailwind over the longer term. And so if we flip to the next chart, we are increasingly constructive on equity markets outside of the United States, particularly the emerging world. I do think the risk of recession in Europe, again, is going to increase as we move through this year. We're not terribly enthusiastic about owning equities in Europe or equities in Japan, but we do see opportunity in the United States, particularly in, again, those growthier parts of the market and some of those more cyclical and value-oriented parts of the market. But we also see tremendous opportunity across the emerging market complex broadly. Now, you can see in the chart over on the right-hand side, valuations in emerging markets, which is the second bar in from the right, are much more attractive than they are in the United States. But to us, it's more about the earnings story. And importantly, higher commodity prices are going to be a significant tailwind for EM broadly and Latin America in particular. Brazil has basically gotten this breath of life, and that's coming after a 10-year period where Brazil was in an extremely difficult position fiscally. From an inflation perspective, it does feel like the tide may be starting to turn for some of those countries in LATAM. And then importantly, you look at what's going on in China. China is effectively moving in the opposite direction from the rest of the Western world. You have the Fed in the United States getting ready to raise interest rates. Fiscal policy is basically dead. I don't think Build Back Better will end up getting passed. And then you juxtapose that with what we're seeing in China, where they're actively cutting interest rates. They're actively easing fiscal policy. And as we've seen over time, a more stimulative China can again be a very powerful force. It can be a rising tide that lifts all ships for the EM complex more broadly. And so just like we're big believers in barbelling our exposures within fixed income, we would be barbelling our exposures globally from an equity perspective as well, having some in the United States, some in the emerging markets, but from a tactical perspective, perhaps avoiding Europe and Japan. There will come a time to step back into those markets, but I'm not sure that it's any time in the next couple of months. And so if we flip to the next chart, taking a step back, it's been a very challenging start to the year. It's been a very volatile start to the year. But I think it's important to remember that at the end of the day, volatility is normal. Volatility should be expected, but equity markets are resilient. And what we're showing here on this chart, the red dots represent the peak to trough decline for the S&P 500 each year back to 1980. And then those gray bars represent the full calendar year return. Now, we put the punchline right up in the subtitle. On average, during the past 42 years, the stock market has fallen by 14%, an average of 14% during the course of the year. However, in 32 of those 42 years, or more than 75% of the time, the market has gone on to finish the year in positive territory. Put differently, if the S&P 500 was a baseball player, it would be batting 750. It would be the best hitter in Major League history by a factor of 2. Again, what this chart shows me is that volatility is normal, but volatility should be expected. And if you look at the far right-hand side, you can see how abnormal of a year 2021 actually was. We had a peak to trough decline of 5%, yet we finished up the year almost 30%. You then look at what's going on in 2022, peak to trough decline of 12%, market sitting 12% down in the red for 2022 as a whole. I do think that we'll be able to dig ourselves out of this hole, but just remember, the volatility we're seeing today is far more in line with what we've seen in the long run, as opposed to what we saw, over the course of 2021 and really even the back half of 2020 as well. And so volatility is always present in markets. It's one of those things that we talk to clients about year in and year out. The question isn't whether or not there will be volatility. The question is what you will do when volatility rears its ugly head. Because if we flip to the next chart, the bottom line here is that volatility makes people emotional. And when people get emotional, they tend to make ill-informed investment decisions. What we show on this top chart is we assume that emotion got the best of you and that you invested $100,000 at the market peak in February of 2020. We assume that you invested $100,000 in a 40-60 stock bond portfolio, which is the dark blue line, a 60-40 stock bond portfolio, which is the light blue line, and an all equity portfolio, which is the green line. Now, all of these portfolios lost money during the pandemic. The question was really how much. But look at some of those recovery times. That 40-60 portfolio recovered its losses by the beginning of June. It would have taken that 60-40 portfolio a little bit longer, but it recovered its losses by the middle of July. It would have taken that all equity portfolio until the middle of August to recover its losses. And I know if you look at the far right-hand side, you can see that over the full time period, that all equity portfolio did in fact outperform. The issue is most people can't hang on during those uncertain times. And we saw the exact same thing play out in the aftermath of the financial crisis, albeit over a longer period of time. The bottom line here is that a diversified approach to investing leads to a smoother ride. And if we can keep the ride more comfortable, we can reduce the chances that our clients make the quintessential investment mistake of buying high and selling low. And the return of the investor who likes to buy high and sell low is represented by that orange bar down at the bottom. That's the return of the average investor. That's the return of the person who doesn't have an advisor, who doesn't have a plan, and who instead allows emotion to dictate their investment decisions. You can see that over the past 20 years, the average investor was frankly a pretty lousy investor. The average investor barely outperformed inflation over that period of time. On the other hand, if you had been in a simple 60-40 or 40-60 portfolio, those two blue bars in the middle of the chart, you would have generated an average annual return somewhere around 6% a year. But importantly, you would have done so with considerably less volatility than the S&P 500. And so again, if we flip to the next chart, diversification leads to a smoother ride. And at the end of the day, my job is really to think about all of the risks out there and try to manage those risks within the context of portfolios. When I think about risks, if I'm being frank, there are risks that I can see and there are risks that I cannot see. We started off this year with a view that the Fed was going to begin hiking interest rates. Higher yields were a very clear risk on the horizon. And I can tell you what to do to protect your portfolio against higher yields. What we didn't see coming at the beginning of this year was a Russian invasion of Ukraine. Those are unforeseen risks. Those are things that you can't necessarily hedge against. And it's those unforeseen risks that require a diversified approach. As you can see on this chart, which looks at the annual returns across a number of different asset classes over the past 15 years, alongside a balanced portfolio comprised of those different asset classes, which is the gray box connected by the black line, you can see that balanced portfolio, it's never the best performer, but it's also never the worst. It trends right along the center of the chart, again, providing clients with a smoother ride over extended periods of time. And when all is said and done, I'm a big believer that if we can keep the ride comfortable, then we can keep our clients invested. And if we can keep our clients invested, we can subsequently improve the chances that they successfully accomplish their long-term financial goals. In what remains a very uncertain world, we continue to believe that a diversified approach and a long-term approach to investing makes more sense than anything else, and believe that that will allow clients to stay invested through this period of volatility and participate in all the capital markets have to offer over the course of the longer term. So with all that said, I'd like to thank you all very much for your attention this afternoon. And Chad, I will turn things over to you to dive into a bit of Q&A.
Yeah, thank you, David, and thank you to all of our guests who are with us today. David, thanks for taking time out of your busy schedule and make yourself available on short notice. There's a lot going on, obviously, and I think you touched on a lot of the big items. I did want to touch on one of the comments you made. You mentioned that this crisis won't meaningfully impact kind of the pace or the path of the economic growth that we're seeing in this country. And I'd like to challenge that a little bit. Why don't you believe that these spikes in commodity prices, energy and wheat and all these things won't impact consumer spending or corporate margins? Because I think that's really where we could see an impact to the case that you presented.
Well, let's be very clear. It's not just about the spike, it's about the duration of the spike. And so if one's view is that energy prices are going to stay at 120 a barrel for the next 3 to 6 months, then I completely agree. And again, part of the thesis around cooler inflation is directly tied to a bit weaker consumption, particularly amongst those lower income individuals. My read of this situation is that we're not looking at something which necessarily persists for that long. I do think that resolution may not be imminent, but it may also not be something for the second half of this year. And so if 6 weeks from now we have energy prices that have moved below 100 a barrel, yes, there will be a period where that drags on the pace of consumption and economic activity, but it's not like it will extend throughout the entirety of 2022. And so again, energy prices are the risk. It's not only about the level that they move to, it's about the duration or the amount of time that they spend at those elevated levels.
Thank you. And I did want to take this time to remind our viewers and listeners, everyone joining us, press the Q&A button at the bottom of your screen if you have a question you'd like to ask David. We'll do our best to get them all answered. So, David, I think there's also a lot of significant unknowns in this current crisis. And I think you touched on this a bit, but how should long-term investors be thinking of this? Is this something they should really just be, looking to ride this out and we know there's going to be lots of volatility over the next few days and weeks and months, or should they be looking to make meaningful changes here?
I think that this is a period where you want to stick to the asset allocation plan that you've put into place. Again, by our lights, this situation in Eastern Europe is still very much noise, whereas the Fed has sent a clear signal. And so to me, arguably the bigger risk than what's going on with Russia and Ukraine is whether or not the Fed overdoes it from an interest rate perspective. We came into this year a bit fearful that the Fed was going to end up committing a policy error and potentially undermining the economic recovery, not necessarily in 2022, but at some point in 2023, as kind of counterintuitive as it may sound, because these events have given the Fed, we believe, a bit more flexibility as they begin to normalize monetary policy. The chances of that soft landing have increased. And really, at the end of the day, what I would say is that it's not about timing the market. It's about time in the market. And if we look over the past 20 years, 7 of the 10 best days for the S&P 500 occurred within 2 weeks of the 10 worst days, right? Volatility tends to be clustered together, and we've seen it in spades over the course of 2022 thus far. The biggest mistake that people can make is jumping ship at a point like the one where we are at, because at some juncture, things begin to turn around. And if you're not in the market when things turn around, well, now you're forced to play catch up. And that can be a very difficult and deep hole to dig yourself out of from a portfolio perspective.
Thank you. We do have a couple of questions. So one attendee is asking if you could describe the barbell approach, so they're not necessarily familiar with that term, if you could provide a little more detail on what that means.
Of course. So effectively what a barbell approach is holding 2 different assets that will perform well in different types of environments. And so in the context of fixed income, one end of the barbell is our core fixed income exposure, right? Our defense, our high quality bonds that in theory will zig when the equity market zags. The other side of the barbell is the income generating fixed income portfolio, which, for the most part is going to move in lockstep with equities, but it's going to provide you with the income that you're not necessarily getting from those core allocations. And so, another way to think of it is it's a balancing act, right? You want to have some stuff that's going to generate income, some stuff that's going to provide you with protection. And when you put them together and roll them up to the portfolio level, you hopefully get what you're looking for your fixed income to provide, which is a combination of defense and yield. The issue in the current environment is there is no single security that provides you with both of those things. So it's a little bit of choose your own adventure or come up with your own recipe. You now need to use the individual components to create that outcome, because it's not as simple as simply selecting one thing and allowing it to play both roles in a portfolio.
Thank you. So an interesting observation is that irrespective of everything going on, and yes, stock markets are down this year, as you mentioned, 10, 12%. Given what's going on, one could expect the stock market to be down quite a bit more. Can you explain, what this equity performance means, and maybe why stocks aren't performing more poorly than they otherwise could be given the backdrop?
Sure. So I think a lot of it comes down to that very first chart that I showed. I mean, it is not clear that what's happening today will have a material impact on the economy and the markets and corporate profits, importantly, over the next 12 to 18 months. I mean, if we all wake up tomorrow and by some miracle they've come to an agreement in Eastern Europe, right, then we're kind of back to where we were 6 weeks ago. And so markets discount the future, right? They try to look ahead and price in what is going to occur. And again, I actually think that this dovetails quite nicely back into your first question of what do you mean there isn't going to be a significant impact on economic growth? Again, it's not clear that energy prices are going to be elevated for long enough that it's going to result in a material deceleration in US economic activity and therefore the growth in corporate earnings. And so, again, the outlook for the fundamentals remains relatively unchanged. And I think that that's the safety net, which is keeping the market off of what could be lower levels. It's not the Fed, right? Usually the Fed comes out and says, oh, the equity market's down, we're going to take our foot off of the monetary brake. The Fed is very much pushing forward here. And so it's really that profit story that we believe is propping up the market relative to where it might otherwise be.
Thanks. So as it relates to that, I think the energy prices, President Biden announced today that they're banning all Russian oil and gas and some other commodities, which is a pretty big step. And oil prices actually didn't really move that. In fact, they kind of came down a little bit on that news, which is interesting. But what do you think this means for the fundamentals of the energy market going forward? Is the worst case priced in here? What could the ceiling for oil look like?
So something very interesting happened a year ago. And you go back to 2016, 2017, 2018, 2019, we were a world awash in oil, right? The shale guys were pumping like crazy. WTI was trading $45, $50 a barrel. The energy sector was effectively left for dead. And then 12 months ago, they came out and said, look, we don't really want to be in the volume business anymore. We want to be in the returns business, and we want to be able to pay dividends and be more responsible in terms of our capital spending. And so you began to see a decline in US supply. Now, this was exacerbated by some of the challenges when it comes to finding labor, but effectively the US, which had become the marginal producer of oil globally, began to decrease the amount that it was pumping. And so, that could not have happened at a worse time. Given the way things have played out here over the past couple of weeks, we do think that shale supply will begin to increase going forward, and it should be sufficient to offset the impact of no longer importing Russian oil. I would also add that from a net perspective, we don't really rely on the rest of the world for oil the way that we did in the 70s or the 90s. Our kind of net figure is right around zero. And so again, I think that that's why you're seeing things come off the boil today, because from a US perspective, this is something which seems manageable. It's Europe that's in the really tough spot because they rely so heavily on Russia not just for oil, but in particular for things like natural gas.
Got it. We've had some questions around kind of how the Ukraine crisis may impact industries, defense industries, and those sectors. And if this is a short-lived thing, is that even something that investors should be looking at, or is it not worth their time?
To me, that's more of a trade and less of an investment. The U.S. we spend a lot of money on defense. To begin with, you have heard out of some countries in Europe, places like Germany, that they're going to begin increasing defense spending going forward. Maybe there's something there, but again, I think that there are other areas of the market that seem a bit more interesting and seem like the themes there are a bit more sustainable. And so to me, that would be a very tactical move. Focused on specifically what's happening in Eastern Europe when we take a slightly longer term horizon, not a 5-year horizon, but say a 18 to 24 month horizon. Again, we come back to other areas like the industrials, like the materials, like the financials, as opposed to being laser focused on something like defense.
What does this conflict mean for investors who have exposure to China specifically? It's been a little unclear what their position is in this, and how should investors be looking at this who are emerging market investors?
So what I would say is I think China's gotten the message. And if you look at the sanctions that have been imposed on Russia and the impact that they've had on Russia's economy, I mean, if China were to say invade Taiwan and the West were to respond in a similar fashion, it would absolutely cripple their economic position. And so to me, the warning shot has been fired to an extent. And I think that, they're doing their best to walk a fine line and not really take one side or the other. But I do think that, the risk around China and Taiwan is the same, if not lower, than prior to the Russian invasion of Ukraine.
All right, and I think we've got time for one or two more questions here, but and then we'll wrap this up. But I think we have had a couple questions asking, I know you mentioned that there are unknown risks that you can't foresee. These types of events often break things that you don't understand yet, that don't always make sense in the current moment. What are some things that we should be watching out for, given the fact that we've seen just dramatic moves in the Russian currency and their stock market and everything over there? What might break that we don't know about yet?
So, I would be keeping my eye on a couple of things. Obviously, energy prices are the clear and present danger. That is what we need to watch in order to figure out the impact here in the short term. More broadly, I think we need to keep an eye on China, not necessarily because of their relationship with Taiwan. Let's not forget, we were engaged in a trade war with China prior to the pandemic, and it kind of got put on the back burner and everybody focused on COVID. That is something which is very much going to reemerge here as these geopolitical tensions and the pandemic both hopefully begin to fade into the background during 2022. And I would say that, from an economic perspective, one of the things we always look for when we're trying to determine how much risk there is around the potential for a slowdown, we always look for imbalances. And we don't really see a ton of imbalances in the economy today. To us, the risks are, the geopolitical risks, the more nebulous risks, the risks that are increasingly difficult to quantify, whether that be the political situation in our own backyard, the relationship between the United States and China, the evolution of NATO. It's the squishy stuff that we believe is potentially the biggest threat to the expansion over the course of the next, call it 12 to 18 months. And that's very difficult to quantify. And unfortunately, it's often a bit of a surprise when things start to go sideways, because the reason nobody knows what a black swan looks like is because nobody's ever seen one coming. And that's the unfortunate reality of these geopolitical risks.
Yeah. So one more question here, and then we'll let you go and let everyone go. I think you mentioned the political risks and the political environment, and maybe one positive thing coming out of all of this is that seems that for the first time in quite a while, we're seeing a little bit more alignment in U.S. politics around kind of a common source of evil, and Do you guys see that as a positive influence for markets and even something that's longer lasting than maybe a few weeks?
I always like to see people, come together, even if it's for the wrong reasons. I actually think that the bigger thing we're focused on from a political perspective is going to be the midterm elections. By our lights, it appears the Republicans will take, one, if not two houses of Congress. And so we end up in the same place with a relatively constructive view, but it's more so a function of the fact that we're anticipating gridlock in Washington over the next couple of years. And markets love gridlock because it reduces uncertainty, right? If you have a divided government, one party can't push through its own set of policies, and the removal of that uncertainty has historically favored capital markets broadly, but equity markets in particular.
Got it. Thank you. So I think that's all we've got time for. Terry, I'm going to turn it over to you. Thank you, David.
Of course.
Thanks, Chad. Thanks, David. That was very educational. On behalf of everyone at Guild Capital Partners, we'd like to thank David and JP Morgan for taking the time to present to us today. We'd also like to thank all of you for joining us on such short notice. Our thoughts are certainly with the people of Ukraine and all who are impacted by this conflict. We will have a replay available within the next 24 hours. Please feel free to reach out to us if you have any questions. We are here to help. We will continue to provide you with information that is relevant to our ever-changing world. So stay tuned for our next speaker series on March 29th at 4 p.m. We look forward to seeing you again soon. Thank you.